are now going to look at interest rate risk. So interest rate risk is the risk of financial loss resulting from changes in interest rates. So very important, this can be seen from two different perspectives depending on whether you are a borrower or an investor. So obviously, guys, borrowers are going to be worried about interest rates increasing. So they are exposed to interest rate risk when interest rates increase. On the other hand, if you are an investor, you'll be worried about interest rates decreasing. So they are exposed to interest rate risk if interest rates decrease. Please note you can only be exposed to interest rate risk when you are dealing with floating rate debt and also floating rate investments. Obviously, if you invest or if you borrow at a fixed rate of interest, then you will not be exposed to interest rate risk. So only if you are borrowing at a floating or a variable rate of interest, or if you are investing at a floating rate or a variable rate of interest, then you are exposed to interest rate risk. If you invest or you borrow at a fixed rate of interest, you will not be exposed to interest rate risk. Before we look at how companies can hedge interest rate risk or manage their exposure to interest rate risk, we need to cover a few important definitions. We need to understand what the repo rate is, the prime lending rate, and also the JIBAR, or the Johannesburg Interbank Agreed Rate. So first, let's just look at the repo rate and the prime rate. The repo rate is the rate that the South African Reserve Bank lends to local banks. So we've got the South African Reserve Bank lending to local banks at the repo rate. Then the prime lending rate, this is the base rate for consumer lending. So individuals that are seeking finance from a local bank will borrow at a rate that is derived from the prime rate. And the prime rate is determined from the repo rate. So banks will then lend to individuals at the prime lending rate. And the prime lending rate is determined from the repo rate. So let's add some percentages here. Let's look at some interest rates so that you can see how this would work. I want you to assume that the repo rate is 7%. So the South African Reserve Bank lends to local banks at a rate of 7%. Then assume that the prime lending rate is 10.5%. So that means local banks lend to individuals at a rate of 10.5%. And remember, we were told above that the prime lending rate is determined from the repo rate. So it depends on what the repo rate is. In my example over here, our prime lending rate is 3.5% higher than my repo rate. So it means banks are lending at 3.5% above the repo rate. You then need to understand JIBAR, or the Johannesburg Interbank Agreed Rate. So guys, this is a rate that is calculated daily, and the calculation is done by the JSE. You can see since the inception of JIBAR, the JSE has assumed responsibility for providing the operational infrastructure in order to calculate and release JIBAR on a daily basis. So the calculation is done by the JSE. And what is the JIBAR? It is the average interest rate at which banks buy and sell money, and it is the benchmark rate for the money market interest rates in South Africa. So we already know, guys, if companies need finance, they can go to the money market in order to raise finance. And remember, the money market is a source of short-term finance for companies. So if companies are looking for short-term finance, they go to the money market, and when they lend money, it's going to be at an interest rate which is linked to the JIBAR, the Johannesburg Interbank Agreed Rate. So make sure you understand all of those definitions. We are then going to look at how we hedge interest rate risk. So what can a company do to try and reduce their exposure to interest rate risk? And once again, we have internal hedging techniques or natural hedges, and we also have external hedging techniques. Let's first discuss the internal hedging techniques. The first thing companies can do to try and reduce their exposure to interest rate risk is to match floating rate debt with floating rate investments. Because think of a situation like this. If interest rates increase, then obviously if you have any debt, you will make a loss on that because you are paying interest on the debt. However, if interest rates increase and you have investments, you will make a gain. So if companies have both floating rate debt and floating rate investments, what they can do is they can offset this loss against that gain, and they can then reduce their exposure to interest rate risk. Another way that they can reduce their exposure to interest rate risk is by mixing floating rate debt with fixed rate debt, or floating rate investments with fixed rate investments. So don't only have debt that is linked to a floating rate or a variable interest rate. Also have debt that has a fixed interest rate, so that you are not exposed to interest rate risk on all of your debt, but only on the portion where there is a variable or a floating rate of interest. So you are only exposed to the interest rate risk on the portion that has a variable or a floating interest rate. Lastly, what companies can do is they can pool. So they can use cash surpluses within the group and offset this against cash shortages so that they don't expose themselves to unnecessary interest rate risk. So once again, let's assume we have company ABC, and it's a big group company, and we've got two divisions. We've got division A and we have division B. And let's say division A is doing really well and they have a lot of surplus cash. On the other hand, division B is not doing well at all and they actually require a loan. Instead of this division going and investing the surplus cash and earning a return on that investment, the money should rather sit in the group's bank account, because then when division B requires finance, they don't need to go to a bank and get a loan. Instead, they just go to the company at a group level, and because the company has the surplus cash, it can be used to cover any cash shortages that we have in division B. So it's much better than going and getting a loan externally and having to pay interest on that loan. So those are the different internal hedging techniques that companies can consider looking at. In addition to the internal hedging techniques, we also have external hedging techniques where we can use forward rate agreements, interest rate future contracts, interest rate option contracts, and interest rate swap agreements. First, we are going to look at a forward rate agreement. So what happens with a forward rate agreement is the rate of interest that will apply in the future is fixed in terms of an agreement. And forward rate agreements are traded over the counter, so very similar to FECs. They're not only traded on a formalized exchange, they're traded over the counter, so you can go to your bank and you can enter into a forward rate agreement. And also very similar to an FEC or forward exchange contract, it is binding on both parties. So both parties must deliver even if the underlying transaction falls through. All right, so we have already covered forward exchange contracts when we looked at currency risk. And remember, a forward exchange contract means that you could fix the exchange rate for a future transaction. Now what we are doing is we are trying to fix our interest rate for a future date. Okay, but the principles are very similar. Let's look at this example. Quicksand Limited needs to borrow R1 million in 3 months' time from a local bank. So 3 months from today, they are going to borrow 10 million rand from their local bank. They are concerned that interest rates are going to increase, and this will have a negative impact on their borrowing costs in the future. So because they're not borrowing today, guys, they're only going to borrow in 3 months' time. So they are concerned that in 3 months' time, when they want to borrow this 10 million rand, that interest rates would have increased. They decide that they are going to hedge themselves against increasing interest rates by entering into a 6-month forward rate agreement today. So they give me today's date. Today is the 1st of July 20x6. And it's going to be a 6-month forward rate agreement that will start on the 1st of October 20x6 and it will end on the 31st of March 20x7. Cash settlement will take place on the 1st of October 20x6 and the forward rate that is fixed in terms of this contract is going to be 9% per annum. So in order to make sense of the information we've been provided with, let's draw up a timeline. We're told in the information that in 3 months' time they're going to borrow 10 million rand, and I'm told my date today is the 1st of July 20x6. In 3 months' time they are going to borrow 10 million rand. All right, which means they are going to borrow on the 1st of October 20x6. What else are we told? They are worried that interest rates are going to increase before they actually enter into this loan agreement. So from today until the date that they actually enter into the loan agreement, they are worried that interest rates are going to increase. So they are trying to hedge against the increasing interest rates during this period over here. So what we are told they are going to do is they are going to enter into a 6-month forward rate agreement, and the forward rate agreement will start on the 1st of October 20x6 and it will end on the 31st of March 20x7. So over here we've got a 6-month forward rate agreement. All right, and during that period we are told that they are going to fix the rate at 9% in terms of that forward rate agreement. We also know that cash settlement is going to take place on the 1st of October 20x6. So that's all of the information I've been provided with. If we look at the required, we need to determine the outcome of the forward rate agreement on the 31st of March and the resulting effective interest rate on the loan. So there's 2 parts to our calculation over here. First, we need to work out the outcome of the forward rate agreement. Then we need to calculate the effective interest rate on the loan. If JIBAR actually increases to 9.5% per annum on the 1st of October 20x6. So we're being told that when they actually enter into the loan agreement on the 1st of October 20x6, JIBAR has now increased to 9.5%. So if they enter into the loan on that date, they are going to pay interest at a rate of 9.5% because interest rates have increased to 9.5%. But they've entered into a forward rate agreement where they've fixed their rate of interest for a period of 6 months. They've fixed the rate of interest at 9%. So let's answer the required. What is the fixed rate in terms of the forward rate agreement? We have a fixed rate of 9%. If they did not enter into the forward rate agreement, they would be paying interest at a rate of 9.5%. So we saw that on our timeline. With the forward rate agreement, they fixed the interest rate at 9%. If there was no forward rate agreement, they would be paying interest at a rate of 9.5%. Therefore, let's calculate the total saving that they have over that 6-month period. Do you guys agree we have a saving of 0.5%? Because instead of paying interest at 9.5%, they're going to pay interest at 9%. So we have a 0.5% saving. The loan amount is 10 million rand. So we're saving 0.5% on 10 million rand over a period of 6 months. So calculate what that saving is. It is a 25,000 rand saving. Please note that is the saving on the 31st of March 20x7. So on the 31st of March 20x7, we have a saving of 25,000 rand because of this forward rate agreement. Now what we need to do, guys, is we need to calculate the present value of that saving. So this is the future value because that is the amount at the end of March 20x7. I need to calculate the value of that amount at the 1st of October 20x6. So let's calculate this present value. We know that our future value at the end of March 20x7 is 25,000, and we are trying to work out our present value. N is 1, guys. We have 1 compounding period. We are not told that interest is calculated monthly, so we are dealing with 1 6-month period over here. 1 compounding period. So you must make N 1, and I is obviously going to be the interest rate. So what was the interest rate on the 1st of October 20x6? JIBAR increased to 9.5%. So please note you need to use 9.5% in your calculation. However, remember the 9.5% is the interest rate per annum. We are only dealing with a 6-month period over here. So you just need to calculate what the interest rate is for a period of 6 months. So either you can just divide by 2, or you could have said 9.5% times 6 over 12. Just get the interest for a 6-month period. We are only dealing with a 6-month period over here. So I've now calculated my present value. So my present value amount over here, if we add this to our timeline, we have a present value of 23,866. So what's going to happen is on the date when we enter into the loan agreement, this is the amount that the bank is going to pay us, or the bank will pay the company, which is Quicksand. Why is the bank going to pay Quicksand? Because Quicksand has made a gain. Because of the forward rate agreement, Quicksand is paying interest at a rate of 9% instead of 9.5%. So we worked out that they have a gain or a saving of 25,000. And this was the present value of that saving. So if Quicksand has a saving, that means the bank is going to pay Quicksand 23,866, which means Quicksand will no longer need to borrow 10 million rand because they've already received part of that money from the bank. So they only need to borrow the difference between these two. So if we look at our solution, you can see on our cash settlement date on the 1st of October 20x6, because the forward rate is less than the market rate of 9.5%, Quicksand is going to receive a cash settlement of 23,866 from the bank. So that means they will not need to loan 10 million Rand from the bank anymore because they've already received 23,866. The net effect is they will only need to borrow that amount from the bank. So let's calculate the outcome. Just go up, guys. The first part of the required was calculate the outcome on the 31st of March 20x7. So let's answer the first part of the required, calculate the outcome. From the bank, they are going to receive 23,866. Then, over the 6-month period, they are going to pay interest on their loan. The loan amount is no longer 10 million Rand. The loan amount is now 9,976,134. When they enter into the loan, the interest rates have increased. So on this loan amount, they are paying interest at a rate of 9.5% because on the day that they enter into the loan agreement, JIBAR has increased to 9.5%. So the interest rate on their loan is going to be 9.5%. And that is for a period of 6 months, which means over the 6-month period, that is the interest that they are going to pay the bank. So that's the interest that they pay the bank. They receive 23,866 from the bank, so that's a receipt from the bank. So the net effect is they have an outflow of 450,000 Rand, which means we can now answer the second part of the required. Calculate the effective interest rate on the loan. Over the 6-month period, what is the interest rate that they are actually paying? If the net effect is they are only paying 450,000 Rand on a 10 million Rand loan, that means we have an effective interest rate of 9%. Once again, guys, why am I multiplying by 12 over 6? Please remember, we always want an annual rate over here. However, this is the amount that relates to a 6-month period. So if it relates to a 6-month period, we need to multiply by what we want. We want the annual rate, so we multiply by 12 and we divide by 6 because that is what we've got. This relates to a 6-month period. And you can see what they've managed to do. On the date that they actually enter into the loan agreement, they are going to have to pay interest at a rate of 9.5% because that is the interest rate at the date that they enter into the loan agreement. However, because they've received this money from the bank, they offset that against the loan amount. So it works out that they are effectively paying interest at a rate of 9% for this 6-month period. So for these 6 months, they pay interest at a rate of 9% instead of 9.5%. And that is because they've entered into a forward rate agreement. So you can see by using the forward rate agreement, they've managed to reduce their borrowing cost from 9.5% to 9%. And if you look at the note below, the entity or Quicksand will only be able to fix the rate at which they borrow when they actually enter into the loan agreement. So on the 1st of October, when they enter into the loan agreement, then they can fix the rate of interest. But before that period, they are exposed to interest rate risk. So during this period over here, they are exposed to interest rate risk because they can only fix the rate of interest when they actually enter into the loan agreement. I can't contact the bank today and say, in 3 months' time, I'm going to loan 10 million Rand and I want to fix the rate now. You can't do that. You can only fix the rate when you actually enter into the loan agreement. So they are worried that over this 3-month period, interest rates will increase. So what they've done is they've managed to hedge their interest rate risk before they actually enter into the loan agreement. So for this 3-month period, they've managed to hedge their interest rate risk. When they actually enter into the loan agreement on the 1st of October, they will then fix their rate of interest at 9.5% for the duration of the loan. Now, in this example that we looked at, my forward rate agreement was less than my market rate. My forward rate agreement was 9% and my market rate increased to 9.5%. So that meant the bank settles the difference in cash with the entity. So we said the bank was going to give the company 23,866. Please note, if it was the other way around, if the forward rate is more than the market rate, then the entity is going to have to pay the bank the difference. Okay, so obviously you don't want a situation like that, because then instead of reducing your interest rate, you end up actually increasing your interest rate.